How bad is the global recession of next year?
The global economy, as you say, Tom, is looking very soft at the moment. In aggregate, our projection is 2% global growth. If you take out our relatively bullish expectation for China, we see global growth at less than 1% next year, which is right on the border of what's been traditionally associated with a global recession. Now, looking a little bit more at the details, we see early next year a fairly severe downturn in Europe, including both the euro area and the UK. And then as the year progresses, the monetary tightening in the United States leads to a recession during the second half of the year here as well. So pretty tough outlook, challenging in a lot of different respects. And that's coupled with an inflation outlook that remains very concerning.
Nathan, financial conditions have eased. With the backdrop you're talking about, financial conditions have started to ease. And that's because a lot of people are thinking about the Federal Reserve backing away from the pace of hikes, go from 75 maybe down to 50, the size down to 25. Nathan, what do you make of that conversation?
I think the Fed has struggled in its communication. It has set up, at least implicitly, a syllogism that if we are serious about inflation, then we go 75 basis points. And when rates are low, it makes sense to have that syllogism. But once you move to 3%, and in November they'll be at 3.75, as you move higher, you've got to start casting your determination and framing your determination to fight inflation in different ways. Specifically, the Fed can say we moved substantially, and that reflects our commitment. And if you don't believe that we're committed, just watch what we're going to do. So I do think they're in a tough situation where they've got to pivot. They can't take rates up at 75 basis points rate indefinitely. And the markets are interpreting that as the Fed kind of pivoting off inflation determination, which I think is a misinterpretation of where they are.
I'm looking right now at some of the GDP components. Michael McKee was breaking them down, and we saw housing. He mentioned housing, and he just clarified that residential investment subtracted 1.37% from GDP. This is a quickly moving story. Under the hood, how much are other inflationary components offsetting some of these disinflationary moves that we're seeing in the housing market, that we're seeing in retail, that we're seeing in used car prices, that you could see on the margins around the economy?
Very clearly, we are now in a dynamic of disinflation in terms of goods prices. That is clearly happening. We expect that it's going to come off quite sharply in coming months. Similarly, the shelter prices are persistent the way they're calculated in the indexes. But when we're getting these monster declines in residential investment, that's pointing to a very soft housing market. But where the heart of inflationary pressures remains is in the non-shelter services. And that is tied to the hot labor market, rising wages, and rising services inflation. That is what the Fed's worried about. And that's what the Fed is targeting here effectively, is they've got to see a more contained numbers in terms of non-shelter services price inflation. And that may yet take a while.
I look, Nathan, at how we're going to recalibrate. We're going to recalibrate off this press conference. John, what, in 4 minutes?
Something like that.
We're going to recalibrate November 2nd. Frame the Citigroup look for next year. I'm going back to your stunning global GDP call of 2% next year. What is your year opening report going to look like? Give us a heads up.
So what we're seeing at the moment, and it's looking pretty durable in my mind, we're calling next year rolling recessions in the global economy. We're going to see various countries turn down. The vast majority of GDP will see a downturn. That would particularly be accentuated and exacerbated if the Chinese economy ends up being somewhat softer, and instead of the 5.5% we're forecasting, if it's more like this year at 3.5%. And so you've got this on the growth side, and then you also have central banks that are going to have to, early in the year, continue to hike. And as the year rolls on, our expectation is hold those rates at high levels. So next year is going to be a challenging year. I'm kind of already turning the page to 2024.